How can family businesses minimize tax during intergenerational transfer? Imagine passing down a family business without losing a big chunk of its value to taxes. It might sound tricky, but with the right planning, it's entirely possible. When a family business changes hands from one generation to the next, several taxes can come into play. These include income tax, capital gains tax, gift tax, and estate tax. The rates and rules depend on where you live and how the transfer is structured. For example, in the United States, there is a large lifetime gift and estate tax exemption, but that exemption is set to decrease soon, so timing is key. Other countries have similar rules, so knowing local laws is important. One effective way to reduce taxes is to gift shares gradually. Instead of giving everything at once, a business owner can transfer small portions over many years. Each year, they can gift up to the annual gift tax exclusion amount, which in the United States is $15,000 per person. This way, they can move a lot of ownership without triggering gift taxes. Over time, this adds up to a significant transfer while keeping tax bills low. It's important to keep track of the lifetime exemption to avoid surprises. Another strategy involves using legal structures like family limited partnerships. These allow the owner to transfer interests in the business to family members while still controlling management. Because these interests often have limited marketability, they can be valued lower for tax purposes. This valuation discount reduces the taxable value of the gift or inheritance. Trusts are also helpful. Irrevocable trusts or grantor-retained annuity trusts can move assets out of the estate while providing income to the owner for a set period. Any growth in the trust's assets then passes to the heirs with less tax impact. Estate freeze techniques are another tool. They set the current value of the business for tax purposes, so future growth is taxed in the hands of the next generation. This can be done through corporate reorganizations or special types of shares. The goal is to lock in the current value now, so any future increase in the business's worth benefits the heirs at a lower tax rate. In some countries like Canada, there are capital gains exemptions available for family business owners. If the shares meet certain criteria and are transferred directly to children or grandchildren, the owner can claim a capital gains exemption up to a specific limit. This can be used either for immediate transfers or gradual ones, depending on the family's needs. When assets are transferred at death, a step-up in basis can help. This means the asset's value is adjusted to their current market value, so heirs only pay capital gains tax on any appreciation after the transfer. Proper planning ensures this step-up applies, which can save a lot of money. Starting early is essential. Tax laws change, and family circumstances evolve. Regular reviews of the plan help keep everything aligned with current laws and family goals. Working with professionals like tax advisors, lawyers, and financial planners is a must. They can help set up the right structures, prepare necessary paperwork, and ensure compliance. Educating the next generation about managing the business and wealth reduces risks of mismanagement or disputes. Keeping detailed records of valuations, transfers, and legal documents is also vital. Special tools like grantor-retained annuity trusts are popular. They allow the owner to transfer assets into a trust, receive an annuity for a set period, and then pass remaining assets to heirs with little or no gift tax. If the business is expected to grow, this can be very effective. Another option is the intentionally defective grantor trust, which removes assets from the taxable estate while the owner pays the income taxes. This is complex but useful for high-growth assets. Including charitable giving in the plan can also reduce taxes. Charitable trusts or foundations can receive business assets, providing income tax deductions and lowering the estate's value. Finally, clear communication and good family governance help prevent conflicts during the transfer. Family meetings, written agreements, and defined roles keep everyone on the same page. Since tax laws can change, families should stay informed and be ready to adapt their strategies. By combining early planning, legal tools, professional advice, and family unity, Family businesses can pass on wealth smoothly while minimizing taxes. This approach helps preserve more of the family's hard-earned assets for future generations to enjoy.